I'll give you some. I'll give everyone some juicy updates, but I'll just answer this straight up because you're here. It holds so nice because we have on-chain collateral that's unrelated to the ecosystem. So fundamentally, the root cause of these kind of like death spiral situations with protocols like Terra Luna is people stop arbitraging the stablecoin back to $1 because when you burn the stablecoin, what you get is Luna. But if Luna's nosediving, you're much better off just selling your UST on an AMM. So if you think about what that flywheel effect is people are consistently losing faith in Luna. So Luna consistently goes down in price, making arbitrage even less profitable. And the only consequence or the only option for these UST holders are to sell on the open market, further pushing UST down, further hurting the price of Luna. And now it's this negative feedback loop where no one arbitrages and it's a race for the exit to get rid of the assets. So our model solves that because at any given point, you're holding one USDS, you know that you can redeem it for one USDC in the reserves, and you're not going to get a shitcoin like Luna or, our governance token. Not that it's a shitcoin, but just for a mental model, you can think of it like that. You get hard external collateral unrelated to the success of the stablecoin.
So in this case, we're saying that basically USDC is pristine collateral.
In this case, and in this market environment, we think that USDC is the most pristine collateral for price stability. Mm-hmm.
Yeah, but then what is the point of what is the point of your stablecoin if at the end of the day it's just backed by USDC?
We'll get into it, but it doesn't actually, in the final protocol state, it's not going to be 100% backed. So there is an algorithmic component that allows for the stablecoin to scale beyond just the limitation of USDC. So now basically any dApp that wants to integrate a stablecoin can get stability, but still allow their users to operate in like a decentralized fashion. They don't actually have to expose themselves directly to USDC. And then in the meantime, it's our DAO's role to decentralize the collateral pool. So once regulation comes through, we're not going to be holding a bag of USDC.
Also, I can add one more point, is the auto yield. So when you hold USDC, you don't get any yield, right? You have USDC and that's it. But if you hold USDS, instead, we will do rebase in average 10 days. So you hold USDS, pay 0 gas fee, and we will rebase the yield we generated to your wallet. So it's we target about 10% to 11% APY depending on the market. So this is another strong reason why you hold USDS instead of just USDC.
Yep, and all that yield is generated from the USDC, the on-chain collateral, then rebased to anyone holding the stablecoin in the wallet. So the stablecoin and contracts are excluded. That's how we're able to generate such a high yield. The most important part is it's non-subsidized. So though the anchor yield was attractive, it was nearly all subsidized. Ours is completely organic and thus sustainable. So, okay, we can go through, now that we've got some more people, we're going to start this thing off, just so everyone knows, we're going to give a brief update as to, who Sperax is, who we are on this call, a brief update since the last time we spoke, and then we'll get into community questions. So you can ask them in the text channel, or you can raise your hand and you can hop up on stage and chat with us. So without further ado, let's get into it. As always, I'll start with an intro. So I'm Alec. I do growth and partnerships here at Sperax. And Sperax is a software development firm, and we build open source financial software. And we deploy it to public blockchains. And the goal of our organization is to make DeFi equitable and accessible for all with super user-friendly products. But of utmost importance, these products must be safe, secure, and reliable for new users. So we're really excited about onboarding the whole next wave of DeFi users into the space. And our beachhead product is USDS, a stablecoin that produces passive income for anyone that's holding it in their wallet. Our approach is novel because for every USDS, there's on-chain collateral. So as we just touched, this collateral is redeemable. So anyone that has a USDS, they know that they can always go to the Sperax protocol and swap it for underlying collateral that is unrelated to the Sperax ecosystem. So this produces a price floor for our stablecoin, and also enabling it to remain rock solid right around $1 during this whole UST and Luna death spiral debacle. So because, holders understand that they can get hard collateral, it reduces the risk of this bank run scenario, which we'll be talking a lot about today. So since the last time we spoke, the Sperax team has made some pretty big developments and some pretty big announcements on Twitter. So I can summarize them briefly. In light of the UST collapse, we've made 3 extremely tangible upgrades to the way we operate and the code itself in order to make USDS more resilient and guarantee that the primary product, the stablecoin, always generates passive income and is always pegged right around $1. So let's get to the 3 improvements. First off, we're 100% backed now. So with algorithmic stablecoins, the protocol can have hard collateral. So this is collateral unrelated to the ecosystem that is backing the stablecoin. This collateral can range from 0%, like UST, only being collateralized by Luna, no external collateral. All the way on the opposite end of the spectrum, there are protocols that are 100% collateralized by external collateral and not collateralized at all by the governance token. So in light of the UST collapse, USDS is now backed 100%. And this is making USDS as secure as possible, just in the short term, to ensure peg stability as we make it through this market turbulence. And something very important to note is that anyone holding USDS now can go to the protocol once redeeming is live again and swap their $1 USDS for $1 worth of trusted stablecoins. So we're very excited about that. Today, it's USDC and a little bit of Tether, but we're in the process of diversifying, and the first product we'll be bringing into that collateral pool is Sperax. And so something very important to note is this is just a short-term move while we work on our second big improvement, which is our transition to a DAO. So we think that centralized leadership and centralized management of the collateral was a point of failure in the UST design that really contributed to the bank run phenomenon we witnessed. So the Sperax team is in the process of making USDS as resilient as possible while we race toward making the protocol 100% on-chain, deterministic, and governed by the token holders. So we'll be, passing the keys to the castle off to the community very soon. And our third and final tangible update that we've done in response to the UST crisis is a massive SPA burn. So to prove our commitment to USDS being decentralized, the Sperax Foundation is going to burn over 500 million SPA tokens this year. And the purpose of this is to reduce the power that we have in the community. So we think that this is a regulatory necessity from a censorship resistance standpoint, but also, if we have control of the protocol because we're majority token holders or even have a large say, we can't be a truly decentralized protocol. So we're removing that risk vector by burning 500 million tokens. We already burned 250 million of them. So if you want to do a little back of a napkin math, that's $16 million of US dollars of SPA we just eliminated from the market. So that's a very promising, price action driver. but also it enables us to be decentralized. So we're halfway through the burn, and we'll be burning 2 more, one in September, and finally the last installment on New Year's Eve. So those are the 3 tangible steps that we're doing moving forward. We're 100% backed. We're racing toward our DAO launch, and we're burning a shit ton of SPA. So those are the updates from my side. I'm going to pass it off to Joe and Sub. If there are any specific updates you'd like to address, feel free, and then we'll be transitioning to the AMA.
Sounds good. I can bring updates from the engineering side. So basically, we're doing 3 things. One is we are upgrading USDS to a more conservative model. As Alex says, we will go more towards the collateral part compared to the algorithm part, because we see this is the wise choice considering the market mentality sentiment right now. And second thing is we are testing everything to make sure the upgrade won't affect your minting and redeeming. So we want to make sure when we unpause, everything 100%, 1,000,000% is correct. We don't want you to lose even a penny. So that's second thing we're doing, testing, intensive testing right now. Lastly, we are looking into other stablecoin protocols as you guys might heard of, there's many stablecoin lose their pack these days. So we are looking into each of them to see what's the problem. And we want to avoid any possible similar problem in our protocol. So that's the 3 things we are doing right now.
Thanks, Joe. Sub, anything to add?
Yeah, I think you guys have covered it pretty well. Apart from that, we are also sort of doing a lot of research on the product side, trying to understand how best to capture this market. And there is a lot of product innovation that is going to come up very soon. So yeah, stay tuned for that as well.
Awesome, thanks, Sub. All right, so we have 2 different types of questions that can be asked. If you didn't realize, we're transitioning to the AMA section now. So like I mentioned, raise your hand. We'll just bring you up on stage. We'll prioritize live questions, and then anything that we still have time for, we will go to the text channel. But we'll be wrapping this up in 30 minutes, so keep that in mind if you're considering asking a question. So we'll start with our first panelist here. Reliano, take it away.
Yes, Reliano. Yeah, good afternoon. How are you doing today?
Good, thank you. How are you?
Hello?
We can hear you.
Yeah, good afternoon. How are you?
Yep, thank you.
Thanks.
Yeah, my question is that to what extent did the recent bear market affect the development of this project, and how did you manage to survive this long bearing market and continue to construction and development? Because recently we see what happened to USD, the lunar stable token. We see what happened in the industry that it hasn't happened for a long time before. So now that we are bringing on USDS, so what do you think? Is it going to last longer for an investor to have hope in it that no, it will also be like the USD? Because a lot of investors, even me also, we lost a lot of dollars on USD because we never had it for a lot from the beginning of this crypto industry, that any stable coin just fall to that extent. Now I think USD is trading at 0.09 cents, and it's so annoying. So I hope there will not be anything like that concerning this your stable token. Thank you.
Yeah, I can start, and then feel free to hop in, Joe or Sub. So first off, on the peg stability front, this recent move toward having a 100% collateral ratio should mitigate any of the depegging risk. So when it comes to holding USDS as almost like a savings account, this is a very safe product to be using as a savings account because of the 100% collateral. And as Joe mentioned earlier, we actually envision a lot of, so specifically, Joe mentioned the 11% native auto yield that the product delivers. We view that this will be a significant growth driver through this bear market. So as people are selling their risky assets, most DeFi native people aren't going to be selling into fiat. Rather, they'll be selling into stablecoins. So we're very well positioned to capture a lot of this market demand, considering we're 100% collateralized, so we're very stable, but we also have the 11% native auto yield. So we expect our TVL to grow throughout this bear market. And as our TVL grows, that means the governance token is controlling more capital, should cause an increase in price. It's also attracting more revenue generation from the collateral in the reserves. So these are multiple different forces that should also increase the value of SPA. So from a bear market perspective, we're actually uniquely positioned to potentially grow during this bear market, where a lot of other projects are likely positioned to shrink. Because as people hedge off risk, demand for products like ours increases. And then from like an actual company standpoint, we're well capitalized and can continue to pay team salaries throughout the bear market. That's not an issue.
Yeah, Sub, go ahead.
Yeah, Joe,
you can go first. No, worry. You can go first.
Okay, so add to that, I mean, Terra is an example of what exactly that needs to be not done, to be fair. So I don't think anyone, in the industry was, at least on the Ethereum side, I don't think anyone was super confident of how they were generating the yield, and anything which is inorganic is like, obviously going to fail. And which is why we will be putting a lot of emphasis on decentralizing the way the protocol allocates its collateral in different yield generating opportunities. And there would be a lot of product innovation in terms of how that part is managed and how that part is functioning. And it's not going to be like USD, where you just have something like Anchor, where they're pre-minted some USD and that's generating yield. That's just not something we think is organic, and that is not something we are aligned with. If you look at other protocols like DAI, where they have a sustainable, stable DAI savings rate and something like that, which is far more decentralized and more conservative in approach. So I think we will take our inspiration from protocols like that instead of spending a lot of time thinking about what USD has done and what has happened over there. And that is what our thought process is. And eventually, since everything is on chain, like I don't think everything was on chain in case of Terra, and there was a centralization aspect to it. In our case, every data point will be available on chain, and you would be able to see how much collateral we are holding, where we are holding those collateral, and USDS holders will be able to redeem their collateral, their tokens one for one against collaterals of actual value. That is what we'll be focusing on in the coming few days, and that is what we'll be working towards. All the while, ensuring that the yield that we're generating is organic and stable, and not something like Terra. So that's one of the most important 2 cents that I want to put forward with respect to this question.
Yeah, I want to add one more point, maybe 2 points. First, we think Terra is a good experiment. we can learn a lot from them. So like two things to mention is first, you should have collateral. You cannot only rely on your own token. Second is you have to use organic yield, not something that you premium or any risky approach that will put your community in any risk. So we have these two on day one, so no worry about that. Second point I want to bring out is another big approach we take to ensure a stable increase during the bear market is we will fully transition to DAO. This is our first priority right now. We think in a bear market, the two things are most important. First is the community's support. It not only ensure that we have consistent support from our user, but also it will ensure our decision is wise and meet the benefits of every token holders, not only like a few of the whales or investors or like the team. We want to go through this bear market with the community. Second, a DAO transition will make the DAO transition will make because you guys know the SEC in the U.S. because we are based in the U.S. Might regulate stablecoin given the UST incident. So we think a fully DAO structure of our protocol will be safer for legal perspective and also can protect the community's assets. So during this disruptive period, a fully Sperax DAO will ensure a stable increase of TVL and also the safety of our protocol.
Thanks, guys. I hope that answers your question. If anyone else would like to ask a live question, feel free to raise your hand. Okay, looks like we'll move on to the text question. I'm going to prioritize the ones that have been live.
Can you hear me? I don't know if you accepted it.
Hey, yeah, the stage is yours. Go ahead and ask a question. Thanks for coming up.
Yeah, sorry if this is repetitive. I got on a little bit late, so if you already covered it, I apologize. But in terms of the backing, like two-part question. One is, you know, how do you plan to back it as supply or demand for the token increases? And then, so how will you grow the reserve? It seems like, from what I understand, that the foundation basically put up the money to back this the equity piece. But if demand for the token grows and you want to increase supply, how do you? Is it only going to you're going to have to put up 100 cents on the dollar when you mint it? Is that basically the plan? I just want to understand, or is there some other way? And is the collateral always going to be USDC behind USDS? Are you examining other collateral types? Sorry, I know it's a multi-part question. And then I guess lastly, like, when do you plan on opening up the redeem functionality? Thanks so much.
Okay, great question, Saul. I think we've covered a lot of these questions, so I'll sort of start with the first one. So the first question was about, is it always going to be, us who are going to replenish the reserves? So the answer to that question is no. We are still in the process of working out what the economic model would be. So one thing that we are going to launch with is we are going to play with the mint and redeem swap fees to ensure that we can have a workaround, what we have built. So in the beginning, the amount of SPA required to mint USDs will be very low as of now when we launch. That is what we are thinking. Nothing is finalized as of now, but yeah, that is what our thought process is as of this point of time. So essentially, to mint like one USDS, you will in the beginning need one USDC, but eventually, let's say after a year, that ratio of how much SPA would be required will go down to, let's say, 1%. So let's say after a year, it would be 99 cents of USDC and 1 cent SPA. That is what we are thinking. So like we want to make the algorithmic component very low in nature, and before we decentralize at least, and then through decentralization, the DAO and the governance can sort of take a call on what should that component be. Should we accelerate that or should we decelerate that? Depends on the market conditions, right? How much capital efficiency do you want? And it's not uncommon. So there are scenarios where you can mint DAI pretty much out of thin air based on some debt obligations, right? So it's not uncommon in the over collateralized stablecoin business as well. But yeah, I mean, so that is something which we are still thinking. But until we reach the point of decentralization, the uncollateralized component would be very low. Now the question would be like, why would someone mint in the first place, right? So as we have previously stated, like it's like holding, it's like a DeFi protocol. So essentially to benefit from other DeFi protocols, you have to stake, unstake, claim your rewards, reinvest, that kind of stuff. So with USDs, if you are a passive DeFi investor, you get the benefit of DeFi without having to do a lot of hard work. You can just hold USDs and earn the stable yield, which is backed by the organic yields from other DeFi protocols like Curve, etc. Right. So that's a current point of view which the team holds, and yes, we will be increasing the gamut of different collaterals choices, and that will be happening in a decentralized manner. Like I don't want the team to take a decision on that and stuff like that. So first we will launch governance, and then SPA holders will sort of vote on which other collaterals will be accepted under USDS, right? So that is something which the DAO will decide. We don't want to take a call on that. But yes, from incidents like UST, it makes it explicitly clear that stable coins like USDC or proven governance tokens and proven tokens like Ethereum will probably, take precedence over something like USD or other algo stable coins as a choice of collateral. Right. So at least that is what I would vote for personally. I don't know what the DAO decides as of now. And yeah, does that answer all your questions?
Yeah, it's perfect. Thank you so much. The last little one was just on the redeem, if there's a roadmap to when that gets enabled. Thank you.
Yes.
I'll exit.
We are currently working on that. We don't have something we can share with the public as of now. We are working very hard. Like pretty much the engineering team is working 24 hours on that as of now. We will be launching it very soon along with the updated protocol specs. So we are changing a few things, as I mentioned before. The chi ratio or the ratio of algorithmic component is going to go down further, and we are going to be mostly backed by collateral and would depend on collateral. And yeah, so as of now, I think we can say that it's going to come soon. The exact specifications and the dates will be live on Twitter as soon as we have it with us. We are taking some extra time to make sure that every part of the code is thoroughly investigated, and we are able to create something which is more resilient in this bear market. So yeah. Great question, by the way.
Cool. I'll put it back to the audience. If anyone would like to hop up, take the mic, and ask the next question, feel free. Okay, I'll pull one from the audience text. So please explain how the VESPA protocol works. So I'll talk about how it accrues value, and then maybe Sub, you could talk about or Joe talk about the VE model at a higher level, just the general vote escrow concept. So let me first start by saying VESPA is a staking protocol that aligns the incentives, allowing for SPA holders, particularly SPA stakers, to benefit upon the success and adoption of the protocol's primary product, the stablecoin USDS, and the SPA stakers. So you stake SPA and you get VE-SPA. Once you do that, you actually earn 3 different types of yield revenue streams. So instead of just holding SPA, you can stake it and then you earn more SPA. And that SPA comes from 3 different sources. So first, you get a 50-50 revenue split from all of the yield generated from the collateral reserves. So say there is $1 million worth of collateral, and it's generating yield at 3% a year. That's $30,000. The SPA holders will be given that $15,000, 50% of the yield generated. That $15,000 is used to buy SPA on the open market and give it to the stakers. The second revenue generating component is the fee reward. So this comes from all protocol fees that are charged to people minting and redeeming the stablecoin. All fees collected in stablecoins are used to buy back SPA and give to SPA stakers. And then third, in the short term, while the collateral pool is still on the smaller side, we're actually juicing up this APY with incentive rewards. So this comes from the protocol itself. These are not long-term rewards. These are just short-term rewards for the early contributors and the early believers. This is over 400,000 spot a week, so it juices the APY up to over 250% for the maximum lock. So this is really important because now it makes the motivation of SPA holders aligned with the building an exceptional stablecoin, simply because they make more money when the stablecoin is adopted. So it aligns incentives and it basically lays the groundwork for the DAO, because once you stake, you'll also soon have governing power on key parameters. And not to mention all of the swapping from stablecoins to SPA in order to distribute to stakers. It's consistent buying pressure on the SPA price, which should help support SPA price over the long term. So as the collateral pool grows with USDS adoption, there will be more and more daily buying pressure from the protocol. So that's how SPA accrues value from the various rewards generated from the protocol, even without the burning component. So I hope that answers the revenue generation question, and then maybe get a brief introduction to the vote escrow model. Sub or Joe, would you be able to brief the community?
Yeah, sure. So the way the vote escrow model works, I think is quite abundantly prevalent in the crypto community or in the ecosystem. So it essentially rewards long-term stakers. So the more the greater the lockup period, the greater is going to be your VSPA balance. And the greater VSPA balance you have, the greater is your share of rewards, plus the greater is the share of your voting power. Effectively, that's how it's going to work. And this is important because we want participants who are long-term stakers, and we want people who are who want to stay invested in the protocol, which is why we have this design in place. And as Alec, you have clearly mentioned that the VSPA holders will be getting the 3 kinds of rewards. And we hope that the 2 rewards will become higher in future. The yield generated through the swapping and fees. And the second one is basically the portion of the income share, which is going to come from USDS. And that those amounts should grow in future. And as you all, So what we do is we purchase US SPA from the open markets using the yield. So that is maintaining a constant purchase pressure on SPA tokens, which is also one of the important aspects of the VSPA model, which is not only returning value to just the VSPA holders, but also to the overall, market, ensuring that there is constant buy pressure on Sperax token. And in future, this is only going to get bigger and bigger. So I think it's going the right direction. And VSPA holders will also hold a lot of power in terms of making the decisions for the Sperax protocol. So if you are a VSPA holder in future, you would be able to determine which collaterals would be accepted in the protocol. So I see that as a something like other stablecoin protocols would like to own or become invested in the Sperax protocol to ensure that their collateral type is accepted as one of the important collaterals. So that can be any of these stablecoin protocols which are currently out there in the market, and that could create a huge buy pressure for Sperax tokens. Then VSPA holders would determine the allocation of Sperax tokens towards different liquidity mining incentives. So in future, we will have something like a Sperax gauge, which will be similar to the curve gauge. And instead of incentivizing, CRV tokens for the specific CRV pools, what we would do is we would incentivize Sperax tokens. We would incentivize different Sperax farms using that curve gauge, and those farms will be based on Uniswap V3. Thereby, it will be much more resilient than Uniswap V2 in terms of the liquidity requirements and price pressures and stuff like that. So that's the other thing. So we are building a Uniswap V3 farm, which we would have already launched if we were not in the bear market right now. But yeah, something that is going to come up and is going to be launched. So the VSPA holders will decide on the collateral composition. VSPA will vote on the incentives for different Sperax liquidity mining campaigns. So this would ultimately create a lot of demand for Sperax tokens, right? And we have already seen what has happened with VCRV, right? It has been a predominant driver of the CRV tokens and CRV price, and in common world language, I think it's known as the curve walls, right? I think everyone is sort of aware of what it has done. So I think we expect something similar with our tokens as well. And so that's sort of the overall picture of how we expect VCRV to grow in future.
Yeah, maybe last point I want to add is the vote escrow model is a model that reward long-term holder and give more power to long-term holder, because the power you have in the DAO is based on the VSPA you hold, not your SPA holding. And the reward you get proportionally to your VSPA balance, not your SPA balance. An example would be someone who has 1 million SPA, but only stake for 1 month, will be equivalent to someone who has only like 2K SPA, but stake for 4 years. So even if you only have 2K SPA compared to someone who has 1 million, they only stake for a month, but you stake for 4 years because you truly believe in the protocol. You too will have the same power in voting DAO and will receive the same rewards in the Vs.
Thanks, guys. Okay, one more time, I'll give the stage to anyone who wants it. If not, I'll be asking a question from the text box. So there are 2 more, and we're coming up on time here. So I'll start with one. How do you plan to reach more users in the next weeks and months now that a lot of crypto users start to lose faith in the general crypto world and specifically in stablecoins after the UST debacle? So I'll introduce a response to that and then let the other guys add to it. So first off, when it comes to the UST situation, we think that our peg stability is going to be one of the most impressive marketing tools for us in the coming weeks. So as people are obsessed with this narrative that algo stablecoins are going to depeg and are waiting for all these algo stablecoins to depeg, we believe that we will prevail and we'll come, rise out of the ashes with this hyper stable yield-bearing instrument that's likely going to catch a lot of attention simply because it just works. So we're very, very excited to use peg stability as a marketing tool in the coming weeks. But in addition to that, we have a couple different very tangible growth partnerships that we're working on. So first, we have a front-end partnership, which is what we're calling it, with a group called StreetBeat. We'll make the official announcement on Monday. But what it is a retail consumer investing application that delivers various trading strategies to retail investors, and we are their crypto partner. So Sperax USDs is available through StreetBeat. Actually, today, you can go download StreetBeat right now, and you can get exposure to USDs. So this is a new massive user base that is a little bit less wary of DeFi and crypto because they don't actually hang out in the crypto space. So a totally new user base that is much more willing to accept crypto. We're now using Web2 partnerships like our one with StreetBeat to deliver the product through a user experience they're familiar with. They don't have to be a crypto expert. They just download StreetBeat from the App Store, they link their bank account, and boom, they got USDS earning 11% yield. So we're super excited about that strategy. And then second off, on the DeFi side of things, we're still racing toward being the decentralized stablecoin for the metaverse. So in order to do that, we need deep liquidity with other decentralized stablecoins. We're working closely with the Frax guys to incentivize a curve pool, which will include Frax and USDS. So if you all remember before the UST blow up, there was a big marketing push around the 4 pool, which was going to be the decentralized liquidity sink of DeFi. And now that UST is out of the question, we think that we're an exceptional candidate to work with Frax to incentivize that pool. And we'll have more details coming out next week on that. And then, just generally, as people go risk off in crypto and people learn that, hey, some algo stablecoins will prevail because they actually work. Then we become a perfect instrument for both DAOs and any crypto trader that's looking to stay inside of the crypto arena, but not actually keep their capital in Bitcoin or Ether. They can keep their capital in USDS, which will remain stable and generate 11% auto yield. So we have a lot of different levers that we can pull and a lot of different strategies that we can push in order to get some short-term growth. But then, in the coming months, once the DAO is live, as Sub just greatly explained, there's going to be tremendous demand for the spot asset in order to pull on these levers and change the levers in order to create an exceptional stable coin. Because once the stable coin grows in adoption, the SPA stakers can profit generously. So it's a really, really kind of harmonious relationship between the stable coin and the spot holders that we would expect a lot of growth, even in a bear market, simply because we're a stable coin. So we're really excited about that. It was a little long-winded, but I hope it answered the question. So what do you think with the underlying USD, or what do you plan to do with USDC backing USDS? We understand that it seems kind of redundant to have a centralized collateral backing a decentralized stablecoin, and we're working rapidly to identify viable alternatives. First, we're going to be incorporating Frax, which though also is backed by USDC, has another layer of decentralization and censorship resistance to it. But then ultimately, we're going to be working with the community to identify and assess the risk of other stablecoins and other collateral types to be added. including their liquidity, their stability, if they're not a stable coin, their volatility in the past, and then ultimately if we can generate yield off for auto yield. So those are all going to be responsibilities of VESPA holders, so SPA stakers. And we look forward to being the analyst for the DAO and helping the DAO understand the trade-offs of various collaterals and identifying ones that are safe, resilient, and can generate auto yield. If you have a question, feel free to just ask it, but I'll move on to the next text question. So this is from Harsha. It's usually stable coins have weaknesses like third-party requirements. Traders and investors typically desire higher returns. So on the first point of third parties, we're 100% on chain, so we don't rely on parties for auditing of reserves. The reserves are always on chain, so you don't have to worry about any third parties. And then in regards to demand for higher returns, we offer a non-volatile passive income of 11%. So for many users, this will be a very appealing instrument. If you want to take on more risk, there's nothing we can do to stop you. Go grab some volatile instruments and you can play a more risky but higher reward game if you wish. But we're trying to provide a product that's risk off, yet still high yielding. Okay, this is an interesting question. So does the market condition need to be bullish in order to bigger rewards? And the interesting thing is, our economic model doesn't require a bull market for the growth of the protocol. And let me explain. So unlike a product like Maker that has a CDP collateral model, which requires demand for leverage, our algorithmic component is very different. It does not require this inherent demand for leverage in order to expand the circulating supply of the protocol. So that means, in order to mint our stablecoin, there doesn't have to be someone on the other side of the coin that is seeking leverage. Anyone with USDC can go mint USDS and begin capturing the benefit of the protocol, which is the 11% passive income. So yeah, in summary, we don't have to have a bullish environment to grow. And as people actually hedge risk and want to enter more stable coins and they want to capture the 11% passive income, it produces more collateral generating yield for our protocol, which produces more revenue for stakers and more buying pressure on SPA price. So we're very uniquely positioned to thrive in a bear market compared to other stablecoin protocols. Those are all of the questions that were had to us today, or that were given to us today. So thank you so much, everyone, for your time. Thank you, community, for expressing concerns and sharing your thoughts with us. And Joe and Sue, thank you so much for hopping on today and sharing your perspective.
Happy to be here. Thank you, Alex. Thank you, everyone.
Take care, everyone.
Guys. Bye.